Hi, so welcome to the live stream today. Always a pleasure coming your way as we continue with our discussion. And we are in the final week for the August 2022 examination and want to just look at a couple of the key topics that we need to focus on and explaining the principles surrounding these key topics. On Monday, we started with a discussion on the consolidated financial statements, trying to state the various principles that we must understand when it comes to the preparation of the consolidated financial statement. So this is the part two and the final session on consolidated financial statements so that we can see the various things that we can do. I see some of you guys joining. You are welcome. Give us a thumbs up on the video when you join, and also comment in the chat box any questions you have for me, something you would want me to share my thought on. I will be glad to provide you with some understanding as we continue with our discussion on the consolidated financial statements. Remember, we mentioned that this is a fundamental topic that is going to be coming in the exam, or if you're writing financial reporting, that is a question one done deal waiting for you in the exam hall. If you're writing corporate reporting, also question one that is going to be there, but the examiner will also bring theories relating to consolidated financial statements, and you have to be aware of and know how the various treatments are done. So I'm going to bring up my screen and then we'll get excited about the discussion. If there are any questions, don't hesitate. Put it in the chat for me, put it in the comment section for me, something you would want me to share my thought on. Let me hear from you as we get excited about our discussion this afternoon and continue with our preparation for the August 2022 examination. So let me bring up my screen quickly and let's get excited about it. Just a quick recap in our discussion. We mentioned that when it comes to dealing with consolidation, generally, there are three options available to the entity that is seeking to expand and grow. Either we just acquire some interest in the company, in which case we don't have significant influence, we don't have control, they need to be treated as investment in associates. Sorry, it will be treated as acquisition of shares, and that will be a financial asset as per IFRS 9. We mentioned that the entity can go a little further by acquiring a significant influence in the company, and that will be treated in accordance with IAS 28, investment in associates. However, the entity can also obtain control, and if the entity obtains control, then in that case, what is going to be happening is that we are going to be undertaking or preparing full consolidation for the entity. So far, we've been able to explain how we obtain control, share our thoughts on non-controlling interest, how they are supposed to be calculated. Then we concluded our discussion on goodwill. That was where we concluded our discussion on, and we made mention of the fact that when it comes to goodwill, it is either going to be a positive goodwill or a negative goodwill, and you saw the various issues that we explained in that case. In case you missed the part one, you can check our the YouTube channel, the playlist, and you can look at the part one that we did 3 days ago. That's on Monday, and we explained the various components about fair value of consideration transferred, share exchange, and the subsequent treatment in that case. In building up on our discussion, the next thing that we want to look out for is the issue relating to impairment in goodwill. So, just the final thing about goodwill is impairment of goodwill. Well, when there is an impairment of goodwill, the way it is treated depends on how non controlling interest is valued. So if non-controlling interest is valued at fair value or NCI is valued at the proportionate method. All right. Now, when the NCI is valued at fair value, then any impairment in goodwill, what is going to be happening is that it will be shared between the parent and then the subsidiary, the NCI. So if NCI is valued at fair value, impairment in goodwill will be shared between parent and the NCI using their percentage of ownership. Okay, using their ownership interest in the respective entity. Using their ownership interest in the respective entity. So if NCI is valued at fair value, then any impairment in goodwill will be shared between the non-controlling interest and the parent entity. However, if we are valuing NCI at the proportionate method, then any impairment in goodwill will solely be charged to the parent entity. That is all. Will be charged against the parent entity, and that is going to be all. It's not going to be allocated, it's not going to be shared. So that is also something we need to understand. The final thing about goodwill when it comes to dealing with impairment in goodwill. All right, that is how we deal with it in that regard. So that's all about goodwill. That's all about goodwill. But you see, the issue about control can be expanded a little bit. The issue about control can be expanded a little bit. So stay with me. Let me touch on control a little bit in a complex environment that is for corporate reporting students, and then it will come back to look at the general principle, and that will be for everybody. So stay with me carefully. So in corporate reporting, we're going to be dealing with complex group structure. So when we say we are dealing with complex group structure, it means that we are going beyond what we see in financial reporting and adding a couple of things to that in that regard. So for instance, we'll have a parent entity acquiring interest in another entity, let's say. So maybe let's put some names up. Okay. So let's say we have the parent entity called Adodi Limited. So we have Adodi Limited acquiring some shares in Bawizi Limited. So Adodi Limited acquiring some shares in Bawizi Limited. All right. So let's say Adodi Limited acquire 80% of the shares in Bawizi, and Bawizi Limited, that means NCI here, it's going to be 20%. Please stay with me carefully. Then let's say that Bawizi Limited goes and acquire another company, Ataoko Limited, and they also acquire 60% ownership in the company. So listen to what is going on there, and then this is a complex group structure exclusively for corporate reporting students. Then we'll come back and explain the general principles. Then we continue. Okay, so stay with me carefully. So Adodi Limited acquired 80% in Bawizi Limited, and so the NCI in Bawizi Limited is going to be 20%. But the question we ask ourselves is, what is the NCI in Adodi Limited, in Ata Oko Limited? What is the NCI there? Now, if you're not careful and he said, oh, the NCI in Ata Oko Limited is 40%, you will be wrong. Because really, the NCI in Oko Limited is not 40%. For that reason, we have to calculate the NCI in Ata Oko Limited. How do we do that? This is the idea. The principle is that any investment that the subsidiary makes, the parent and the NCI have their share of ownership in that investment. So any investment the subsidiary makes, all right, the parent and the NCI have their ownership interest, in the investment. Now, stay with me carefully here. This is where the journey is going to get a little bit interesting. So, whatever investment the subsidiary makes, the parent entity has its share of interest in that. The NCI also have their interest in that particular investment. So, let's look at what I mean by that. So, Adodi Limited acquired control in Bawizi Limited. Bawizi Limited in turn controls Adodi Limited. The question is, can Bawizi Limited prepares consolidated financial statements? The answer is no. Why? Because if you remember the rules we established, we said an entity cannot prepare a consolidated financial statement if that entity is controlled by another entity. if that entity is controlled by another entity. So in the context of this question, Bawizi Limited cannot prepare consolidated financial statements. So the question we ask ourselves is, how do we calculate NCI in Acca Limited? Acca Oko Limited. That is the concept here. That is the idea. So calculation of non-controlling interest in Acca Oko Limited, which is the sub-subsidiary. Okay, which is the sub-subsidiary. So how do we calculate NCI in Acca Oko Limited, the sub-subsidiary? The way you do that is to first calculate the controlling interest in Acca Oko Limited. So let's look at the controlling interest. When we say controlling interest, we mean how much the parent entity is having in the subsidiary. Remember the statement we made here. We said any investment the subsidiary makes, the parent and the NCI each have their share of ownership of that investment, right? So for that reason, what's going to happen is that the controlling interest in Acca Oko is going to be our ownership of Bawizi of Acca Oko's share. So it will be 80%. Adodi owns 80% of Bawizi, and Bawizi has acquired 60%. So that is how we calculate the controlling interest. 80% of 60%, that will give us the controlling interest. So what do we have? 80 by 60 divided by 100, that is 48%. Stay with me carefully here. 48%. Now, the total is 100%. So it means the non-controlling interest in Acca Oko Limited is the balancing figure, which is 52%. Please stay with me very carefully here. So then somebody will say, oh, if our controlling interest in Acca Oko is just 48%, that's below 50%. So it means that we cannot consolidate the results of Acca Oko Limited. But that is not true. We have to consolidate the results of Acca Oko Limited. Why? Because Adodi Limited controls Bawizi Limited, which in turn controls Acca Oko Limited. So as far as we control the company that controls the sub-subsidiary, then we have to consolidate. I hope you're getting the treatment here. So even though the controlling interest of the parent entity in the sub-subsidiary is just 48%, the sub-subsidiary's financial statement, that is Acca Oko Limited in the context of this question, will still be consolidated. Why? Because Adodi Limited, who is the parent entity, controls Acca Oko, controls Bawizi Limited, which in turn control Acca Oko Limited. That is the concept about complex group structure. So all the time, if there is that complex group structure in there, then it is important for us to identify and know about the non-controlling interest in the entity. Now, that is just one example of the idea. And remember, this is the fundamental rule that you must know about, because this rule is going to set the tone for the workings that has to be done later on. Let's look at another illustration. Let's say still this time around, we will go with something else. Uzla Limited, let's say, acquires maybe Jazza Limited. So Uzla Limited acquires maybe, Jazza Limited. So they acquired 75% of the company. Then Jazza Limited also acquired Mumsy Limited. They make an investment of 52% in them. So, but then Uzla Limited also has some investment in Mumsy Limited. Maybe let me make Jazza Limited investment just 35%. Then Uzla also has an ownership of 25% in Mumsy Limited. Now, stay with me carefully. Let's get an illustration. So, in the context of this scenario, definitely Uzla Limited is the parent entity, Jazza Limited is the subsidiary, Mumsy Limited, it's quote unquote the sub-subsidiary here. So, NCI in Jazza Limited is going to be 25%, isn't it? Because we own 75, so NCI is going to be 25%. Very simple there. So the question we then ask ourselves is, what is the NCI, non-controlling interest, in the sub-subsidiary or Mumsy Limited? So here we have to find out, there is a direct ownership and then there is an indirect ownership. So let's bring in our direct ownership. So direct controlling interest that Uzla has, it's 25%. Then they have an indirect ownership, indirect controlling interest from the investment that Jazza is making. So that's 75% by 35%. Let's see what we got. 75, 35 divided by 2. Ooh, 75, 35 divided by 100. That's 26, maybe approximately, just 26%. So when we combine it up, our combined interest, combined controlling interest, is exactly 51%. So it means that non-controlling interest is going to be the balancing figure, which is 49%. Are you getting it? So non-controlling interest is 49%. Now, in the context of this scenario, can we consolidate the financial statement of Mumsy? Yes, we can, because combined controlling interest is 51%. But assuming Usla was not having ownership in Mumsy, that means the investment will be treated as an associate as per IAS 38. The investment will be treated as an associate as per IAS 38. As per IAS 38. So that is the concept about complex group structure and how you calculate the non-controlling interest. Now remember, if you miss that, you're going to be in a big trouble. You're going to be in the big trouble. So that is the complex group structure. Any questions? I see some of you joining. You can put it in the chat for me. And also give us a thumbs up on the video if you're getting some value. It helps us a lot so that we can reach a lot of other students just like you. So together we can assist a lot of students. So give us a thumbs up on the video if you're getting some values. And also, share the video. Let's reach as many students as possible watching this video. Now, once we calculate the controlling interest and the NCI in the sub-subsidiary, the way goodwill is calculated in the sub-subsidiary is very, very important. So goodwill in the sub-subsidiary calculation, remember, like I said, this is for corporate reporting students. Like this part of the discussion is for the corporate reporting students. So how do we calculate goodwill in the sub-subsidiary? This is something you have to be very careful about, very careful of. Remember the statement I made here. I told you that any investment the subsidiary makes, the parent entity and the NCI have their ownership interest in the investment. So what does that mean then? It simply means that when we are calculating the NCI in the sub-subsidiary, the fair value of consideration transferred, the fair value of consideration transferred, the fair value of consideration transferred will be the parent ownership of the subsidiary multiplied by the fair value the subsidiary paid to the sub-subsidiary. Ooh, that's very important. Okay. So ownership interest in the subsidiary, okay, multiply by the fair value of consideration paid by the subsidiary. Sounds good? That's how we get a fair value of consideration transferred. Very, very important. Very, very important. So when we are calculating goodwill in sub-subsidiary, that's how we calculate fair value of consideration transferred. We pick the parent entity's ownership of the subsidiary and multiply it by the money the subsidiary paid the sub-subsidiary. Then everything else follows the same way as you know to calculate goodwill. But this one is the key identity or key thing that you need to understand. So goodwill in the sub-subsidiary will be calculated as ownership of the parent in the subsidiary multiplied by the fair value of consideration transferred to the sub-subsidiary. I hope that is clear. So that is the exclusive treatment that has to be made relating to calculation of goodwill in the sub-subsidiary. Anything else will follow. Fair value of NCI will be brought, net asset at acquisition, the same issue like we discussed, and there's not going to be an issue. Then the second thing that we have to pay attention to when there is a complex group structure is the NCI value. So the non-controlling interest in the subsidiary. Non-controlling interest in the subsidiary. Now, the non-controlling interest calculation in the sub-subsidiary, we don't need a miracle for that. That is the same thing as you know already. But the calculation of non-controlling interest in the subsidiary is exclusive. It has a specific feature. What does that mean? It means that we'll bring the fair value of, non-controlling interest at acquisition. Yeah, you're going to bring that. But remember the statement we made here. We said any investment the subsidiary makes, the parent entity and the NCI have their share of ownership or share of ownership interest in that investment. What does that mean? It means that the money that the subsidiary paid the parent is no longer in the subsidiary and has been pushed to the sub-subsidiary. So for that reason, we will less the NCI's share of investment into the sub-subsidiary. We will less it from the NCI in the subsidiary because that money is no longer in the subsidiary. So the way you do that is that you pick the NCI's ownership interest, then you multiply it by, you pick the NCI ownership interest in the subsidiary, then you multiply it by the fair value of consideration paid by the subsidiary. Paid by the subsidiary. That figure will be deducted in calculating the non-controlling interest in the subsidiary. This is a very crucial workings. So you realize that the parent portion of the money the subsidiary paid was taken when we're doing goodwill in the sub-subsidiary. Will be taken when we are doing goodwill in the sub-subsidiary. Then the remaining amounts will be deducted when we are doing non-controlling interest in the subsidiary. These are two key adjustments that are required when we are dealing with sub-subsidiaries, when we are dealing with sub-subsidiary. Any questions? You put it in the chat for us. I see some of you guys joining. Give us a thumbs up on the video. This is our discussion on consolidated financial statement, part 2, focusing and discussing the key fundamental principles when it comes to preparation of consolidated financial statements. And we are trying to establish control, calculating NCI, calculating goodwill, especially when there is sub-subsidiary. So if there are any questions, put it in the chat for me. Want to hear from you, and let's see what we can do here. So that is also what you must understand when we talk about complex group structure. Like I said, this is for corporate reporting students so that we can determine the group structure, calculate the NCI, calculate goodwill in the sub-subsidiary, then calculate NCI in the subsidiary. So anytime these things are there, the treatment, we have to be mindful of them. It's very, very important. Very, very important. But like we mentioned, we don't only consolidate the results usually because we have control, but then sometimes there could be investment in associates. So let's share some thoughts briefly on investment associate. Then we'll go to intra-group trading. Then that will be the final part. So investment in associates. So investment in associates. Investment in associates. Now, like we established in the beginning of our discussion, if we acquire maybe more than 20% or we get significant influence, then we have to account for the transaction in accordance with IAS 28, investment in associate. But the question we ask ourselves is, what is significant influence? We must know what is significant influence. What is it? And what are the indicators of significant influence? What are the things which, when we see, we can say, oh, the entity has significant influence over the investee firm? What are some of the things? So let's go to my slide and let me bring some of these thoughts up with you in our discussion. So just one liner definition, significant influence. Now, this is coming in from my book on corporate reporting and financial reporting, a new book that we released this year, which is available and you can get copies of. So, significant influence. Remember, we said control is the power to govern. Control is the power to govern. What is significant influence? Significant influence is the power to participate in the financial and operational or operating policy decisions of the investee, but is not control or joint control over those policies. So, significant influence gives us the power to participate, to be involved in the decision making process of the entity. However, control gives us the power to govern it. So that is what we mean by significant influence. That's what we mean by significant influence. But a key question we ask ourselves is, what are the indicators of significant influence? What is it that when we see, we can conclude and say, oh, the entity has significant influence? Remember, we've discussed what we will see for us to conclude there is control. But what are the things which, when present, we can conclude and say this is significant influence? So let's look at some indicators of significant influence here. Indicators of significant influence. Let's discuss some of the points here. Now, remember that by default, sometimes when we acquire a significant portion of the company, any acquisition that is below 50% can give us significant influence. Any acquisition below 50% may give us significant influence by default. But then there are other things which, when present, we can say this is a significant influence. So let's look at them. Number one, representation on the board of directors or equivalent governing body. If our investments allow us to have representation on the board or any governing body of the entity, then that is a significant influence. Then that is a significant influence. That is very, very important. So once we have a representation on the board, it means we have the power to participate in the policy making decisions of the company. But not only that, Participation in the policy making process, including decisions about dividends and other distribution. Yes, since we have a representation on the board, guess what? We can participate in the decision that we make about dividend and other distributions. That is another indication that we have a going concern. Sorry, we have um, a significant influence on the company. Then we have material transactions between parties. Sometimes transaction between parties can also create significant influence. So maybe we don't have an investment in the company. However, we are related parties. Are you getting it? Like IAS 24 situation, related party. And that's the related party, the transaction that occurs between us is material enough to enable us to make various decisions about the company or be involved in the decision making authorities of the company. So even though directly we don't own the company, if we are undertaking some material decision, we may be able to treat them as our associates if that material transaction gives us a decision making authority or right on the company or right on the company. I see some questions coming up. Let's see if we can take some of them real quick and then we get excited about it. Let's see, what do we have? Charity Badago said, hi, hello, Charity. Thanks for joining us. Toby Alime said, good evening, Toby. Daisy said, hello, Nhyira. You are doing fantastic job. Okay, Kenya, thanks for joining us. What do we have? Zodok Mills with a thumbs up there. Thank you for joining us. Alfred Kabagore said, hello, Nhyira. I would like you to explain IFRS 7. Okay. We are looking at consolidation today, though. We're focusing on just consolidation. Nhyira, thanks so much for being there. That is William Nya. Thanks very much. Henry said, lo, I'm late. Don't worry. I think you're not that late. Musa said, I'm glad I joined on time. That's awesome to hear. Bell Gifted said, please, is today's lesson only for corporate reporting students? We're doing corporate reporting and financial reporting. We are focusing on consolidated financial statements. So if you're doing financial reporting and corporate reporting, fine, you are good to be part. Binia Mulima said, how can I access your book? You can buy the book or buy it on Amazon. There is a number scrolling below the screen. You can WhatsApp that number 05011149296 and be able to place a copy. Hamza, good evening, sir. Good to be here. God bless you. God bless you too for joining us. Let's see. Any questions, please put it in the chat for me. When next are you going to have online lectures? You'll be notified about that. We will be live on Friday, 4:30 p.m. Nhyira, today, dear, I catch your video. I catch your live video more times. So, okay. I think that's what you're trying to say. Vincent said, Nhyira, watching from Tanzania. All right. That's high. That's great to hear from you. Dennis Kiwanga said, hello, sir. How are you doing? I'm flourishing. How are you? You are having a nice job, sir. May Almighty God bless you. Amen. And God bless you to Dennis for joining us from Tanzania. So we have Kenya, we have Tanzania, we have Nigeria, we have Ghanaians, my people, and everybody else coming in that particular case. Okay. Any questions, please put it in the chat for me as we continue with our discussion. So that is a concept about investment in associates. But once we identify the investment in associates, how do we account for it? In accordance with IAS 28, investment in associates, we use the equity accounting method. The equity accounting method. So the equity accounting method is where you simply have to bring in, the cost of the investment, how much we paid to the associate. So the cost of investment, how much was paid to the associate. Then we'll bring in, share of post acquisition profit or loss from the associate. So we use the equity method to determine the carrying amount of the investment in associate. That's what we are trying to do. That's what we are trying to do. Of the investment in associate. Okay? Of the investment in associate. So their profit will be added, loss will be deducted. Very simple like this. Then, if there is impairment in the investment in associate, we'll bring our share of impairment in the investment in associate. Impairment of the associate. Now, be careful here, just our share. Just our share. So, if the associate suffers an impairment, our portion of ownership of the company will reduce our investment. So, we bring it up. We bring it up. Very, very important. Very, very important. Then, if it happens that the uh, parent entity has sold some goods to the subsidiary, to the associate, and they've not sold it, finished selling it, provision for unrealized profits may come in. Now, I'll explain this to you in a moment, but we'll take the parent's ownership of the associate of the PUP that is calculated. And I'm going to explain this to you a little bit later on. And the PUP will be deducted. If we receive any dividend from them, the dividend will be less. And that is what gives us the carrying amount to the statement of financial position. So if you are preparing statement of financial position, then it is important for us to calculate the carrying amount. Please note, if you are preparing the consolidated statement of profit or loss, we don't need to do these workings because all we'll be interested in is share of profit. Note that it is share of profit that goes to the consolidated profit or loss account. Then any impairment will also go to the profit or loss account as well in that case, not the dividend received. Not the dividend received. Dividend received from the associate is not a P&L item. It is share of profit from the associate that we take to the P&L. So be mindful of that because in some questions, the examiner could say that, oh, the company received dividend of X amount from the associate during the year and it's included in other income of the parent entity. For consolidation purposes, the dividend received from them will not be included there. It is the share of our post-acquisition profit that will be brought in the P&L account. So that is the equity accounting and how we deal also with investment in associates. Investment in associates. So we've looked at issues about control. We've discussed issues relating to NCI. We've discussed issues about goodwill, and we've spoken about issues relating to, you know, investment in associates. Investment in associate. Then the next thing we look at is intra-group trading. Intra-group trading. Intra-group trading. Now, this is one of the challenging areas in consolidation, how you deal with it. So stay with me carefully. We're going to try as much as possible and simplify this for you so that you can really, really understand how it goes. Now, there are various types of intra-group trading. It could be good sales of goods. It could be disposal of assets. So we're going to come in from all other angles, but I want you to stay with me carefully as we try to explain these principles generally. So number one, sale of goods. Sale of goods. So if there is a sale of goods occurring between them, now before then, let me make this statement first across board that on consolidation, The impact of all intra-group transaction, the impact of all post-acquisition, that word is very important, post-acquisition intra-group transactions, intra-group transactions must be eliminated. Very important. Very, very important. Keyword, all post-acquisition, 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 post-acquisition. It means if they had traded before we gain control, it's not going to be adjusted on consolidation. If there was any trade prior to gaining control, it's not going to be adjusted. It is only the trading that is occurring post acquisition that will be adjusted. Very, very important. Very, very important. So, based on that premise there, let's look at some of the scenarios and how we deal with them. So, if there is sale of goods, what do we do then? If there is sale of goods, principle number one, total sales for the post acquisition period shall be removed, shall be removed from cost of sales and revenue. Now, we do this if we are preparing the consolidated statement of profit or loss. We are preparing consolidated statement of profit or loss and OCI. So the total sales will be removed. When we say it should be removed from cost of sales and revenue, what does that mean? It means you debit revenue. Now, remember, revenue has a credit balance. So when we say debit revenue, it means subtract it from revenue. Credit cost of sales. Cost of sales is an expense, keeps a credit balance. So when we say credit cost of sales, it means subtract it from cost of sales. So the total post-acquisition sales is deducted or less from revenue, the same figure, and is also less from the cost of sales. Why? Because it is sales for the entity selling and it is cost for the entity buying. It is cost for the entity buying. It is cost for the entity buying. So that is the first thing we do. The total post-acquisition sales should be eliminated if you are preparing consolidated statement of profit or loss. But not only that, number two, if during the year or included in the closing inventory there is unsold goods, which is part of the post-acquisition purchases, we have to calculate provision for realized profit. So II is provision for realized profit. Provision for unrealized profit. So it has to be calculated. That's what we call PUP, or you see as PUP sometimes, provision for realized profit. So PUP shall be calculated on any unsold post-acquisition purchases. What does that mean? It means that provision for realized profit will be calculated on both unsold inventories unsold inventories or unsold inventory, and goods in transit. Now, what is goods in transit? Goods in transit is where it's goods in transit. It means that the entity selling has issued the goods, has dispatched the goods, but as at the time the entity buying was preparing the financial statements, the goods hadn't been received yet. So certainly it means they've not sold it. So if anything, we have to calculate provision for unrealized profit. So usually provision for unrealized profits about goods will be calculated on both the unsold inventories which are already in stock for the parent, for the entity buying it, then also on goods in transit if there is anything like goods in transit in the question. Now, the treatment of the PUP depends on who is doing the selling. So for instance, if you are preparing the consolidated statement of profit or loss, we are preparing consolidated statement of profit or loss and OCI, then you need to debit cost of sales with the provision for unrealized profit. When we say debit cost of sales, it simply means you add it to cost of sales. So whatever provision for unrealized profit you calculate, you add it to cost of sales. If you are preparing the you know provision for, you are preparing the P&L account, you just add it to cost of sales, that's all. But you need to calculate the post acquisition profit of the subsidiary as well. Post acquisition profit. So sometimes we may debit profit for the year. Now, when we say debit profit for the year, this is if the subsidiary is the one doing the selling. So if, because they've not earned that profit yet, we have to subtract it from their profit for the year. Okay, so when we say debit profit for the year of the subsidiary, we mean subtract it. If the parent is the one selling, then certainly provision for unrealized profit will be subtracted from group retained earnings or consolidated retained earnings. That is if the parent is the one doing the selling. So the entry will be based on the entity doing the selling. If the subsidiary is the one doing the selling, then the provision for unrealized profit will be deducted from their profit for the year so that we can calculate the post-acquisition profit or loss. But if the parent is the one selling to the subsidiary, then the provision for unrealized profit will be deducted from group retained earnings or consolidated retained earnings or consolidated retained earnings. Then, if you are preparing the statement of financial position, if you are preparing the statement of financial position, we credit inventory. So we're going to deduct it from inventory on the face of the consolidated statement of financial position. Why are we doing this? Because as per IAS 2, inventory should be carried out lower of cost and net realizable value. And if we don't calculate the provision for unrealized profit and we consolidate their results, one entity will be carrying the inventory at the sales value, but that will be against IAS 2 inventories. Hence, we have to remove the profit element of the goods that have not been sold as at the reporting date, because the two shall be one and you cannot make profit in between each other. That is the idea about provision for unrealized profit. So if you are preparing consolidated P&L, add it to cost of sales. That's all. But if you are preparing the consolidated statement of financial position, you have to find out who is doing the selling. If the parent is the one doing the selling, it goes to the consolidated retained earnings or group retained earnings. If the subsidiary is the one doing the selling, then it will be deducted from their profit for the year. It will be deducted from their profit for the year. Any questions? I see some of you joining. If there are any questions you have, You can put it in the comment section for me if you're on Facebook, or the chat box if you are joining us on YouTube, and we will be able to, take your question and then provide you with some answers for the question as well. So that is the idea about provision for unrealized profit. But it doesn't end there. Still, we are on sale of goods. So the third thing is reconciliation of the current accounts. Reconciliation of current accounts. You see, no one is supposed to owe somebody. The two shall be one. So the parents cannot have any amount that they owe the subsidiary. The subsidiary cannot say they owe the parents when we are consolidating. Because when we are consolidating, we put the two results together. So if you are going to put the two results together, then we have to eliminate payables and receivables in the books of the company. So the third thing may be to reconcile, because sometimes their figures may not be the same. So just for illustrative purposes, I'm going to say, let's say the parent sells to the subsidiary during the year. So in the question, the parent is selling to the subsidiary. Now, if the parent is selling to the subsidiary on credit, then in the books of the parents, they will have what we call trade receivables, isn't it? Because when you sell to somebody, the person becomes your debtor. So in the books of the parent, they will have this amount due from the subsidiary as trade receivables. Then the subsidiary will have, inclusive in their trade payment, trade payable, the amount due to the parent entity in their trade payables. Now, usually we expect these figures should be the same so that on consolidation, we can remove their impacts on the face of the financial statement. But sometimes they are not the same, so we have to find out and bring it on an equal ground. So let's continue with the illustration. Like I said, we are assuming the parent is selling to the subsidiary. So the parent company has trade receivables, the subsidiary has trade payables in respect of the intra-group sales. In respect of the intra-group sales. So let's see what we have. So I'm going to have the parent here. Then I'll have the subsidiary there. So like we said, when it comes to trade receivables, that will be found in the parent's book. And then when we come to trade payables, that will be in relation to the subsidiary. Like I mentioned, we expect that these figures will be the same, but sometimes they are not the same. So we have to find out what is going on. So let's say in the parent books, they have $6,000, which is an amount receivable from the subsidiary. But then in the subsidiary books, they think they owe the parent, or they per their records, they owe the parent an amount of 3,200. Please stay with me carefully. Why are the figures not equal? Because the figures are supposed to be the same. Why? Two reasons. It could be because the parent has sent some goods to the subsidiary, or subsidiary has wired the cash and the parent had not received it yet. So let's look at the first scenario, cash in transit. So maybe the subsidiary has sent some money, has sent cash to the parent, but the parent did not receive the cash until after the reporting period. So if they have sent them cash, how much did they send? We will balance and know. So the parents, in the parents' books, they have not received the cash yet. So 6,000. We expect that the subsidiary should be 6,000, but the subsidiary has sent us some cash. So how much did the subsidiary send? The balancing figure will become how much the subsidiary is sending to us, and that is going to be the amount of, so cash in transit. So the cash in transit is going to be the amount of what? That'll be 2,800 That's the idea. That's the idea. So they have sent a cash of 2,800. That is why the balance was not the same. Now, there are two ways to balance this up. Usually, the idea is that we push the cash into the account of the person supposed to receive it. So we can rebalance the account and make it as 3,200 and bring the cash below this. But whatever be the case, now when we consolidate, what do? You bring trade receivables. So on the consolidated statement of financial position, when you bring trade receivables, you bring the parent figure, you bring the subsidiaries figure, then you subtract how much is outstanding in the books of the parent that is due from the subsidiary, which in the context of this question is 6,000. Just for our illustration, it's 6,000. So we will subtract the 6,000. Then when you write trade payables, you bring the parent figure, you bring the subsidiaries figure, then you deduct how much of payables relating to the parent that was in the books of the subsidiary, and that is 3,200. Then you come to cash. You bring the parent's cash, you bring the subsidiary's cash. Remember the cash in transit, you add it back. Why must you add it? Because it has been paid by the subsidiary, but has not been received yet by the parent. So we have to, on consolidation, we have to bring them up. So that is how we would reconcile and prepare the items in the statement of financial position if there was a cash in transit. And that is the third issue, reconciliation of the current account. Like I mentioned, the second thing could be goods in transfer, goods in transit. Now, if there are any questions, you put it in the chat for us, then we can take it. So, what if there is goods in transit? So, let's bring that up. Again, we are assuming the parent is selling to the sub. So, parent, subsidiary, parent, subsidiary. So, in the books of the parent entity, we will have trade receivables. In the books of the subsidiary, we will have trade payables. So let's put in some figures. So in the parent books, they have that the subsidiary owes them for 14,000. But as per the records of the subsidiary, they owe the parent only $8,000. Why is that? Maybe because there is a goods in transit. So the difference in the two figures could be because the parent has sent goods which were received by the subsidiary after the reporting period. After the reporting period. So if the parent has sent some goods and the subsidiary has not received the goods as at the reporting date or after the reporting date, then that will be one of the reasons why this account is not balancing. So now we will balance it. So goods in transit. So how much is it? 14,000, 14,000. The balancing figure will be goods in transit. Sometimes the examiner will give it to us, or we would have to figure it out ourselves, and that's 6,000. So the 6,000 becomes the goods in transit. The 6,000 becomes the goods in transit. And that is how we now reconcile the accounts. So on the consolidation, trade receivables, we bring in the parent figure, the subsidiaries figure, then we'll subtract how much is outstanding. In my illustration here, 14,000. Then we bring trade payables. We bring trade payables. We bring the parent figure, the subsidiaries figure. Then you subtract how much was outstanding. That's 8,000 because that is what they have in their records. Then we bring in the inventory. We bring in the inventory. We bring in the inventory. So if we bring in the inventory, we bring in the inventory, we bring the parent figure, the subsidiaries figure, then we'll add goods in transit, GIT, goods in transit. But if you remember, I told you something, that provision for unrealized profit is calculated on what? Both the unsold inventory as well as goods in transit. So since there was a goods in transit, we have to calculate PUP on it. So you subtract the PUP from here. And that's how you get the consolidated figures respectively. And that is what we mean by reconciliation of the current accounts when there is sale of goods. When there is sale of goods. When there is sale of goods. Any questions, please? Any questions? Any questions? Any questions? You put it in the chat for me, or you put it in the comment section for those of you joining us on Facebook, and then we see. Any questions for me? I see some questions coming in. How can you explain? Hello, sir. Can you explain a little bit of what IFRS 3 and 27? IFRS 3 is business combination. That's business combination. It gives you the rules on how you deal with goodwill calculation and deal with uh, general consolidation. That is what IFRS 3 does in that particular case. IAS 27 is about the rules governing the separate financial statements. So in the separate books of the companies, how do they keep records of the investment they have or them being controlled in that particular case? So IFRS 3 is business combination. It provides the rules for calculation of goodwill. It provides the rules for consolidation generally in that case. So the IFRS 3 is used in conjunction with IFRS 10, which is consolidated financial statements, to now prepare the consolidated financial statement, establish control, deal with non-controlling interest, and then consolidate the results generally as well for the entity. Akim Kana said, CR is my last paper to complete CA. I am happy to be here. God bless you, my mentor. God bless you too, and wishing you the best in your paper. Zamzilu Ado said, Hi, Nhyira. Well done for the good job. We are always excited. God bless you, sir. Amen. God bless you too. You are making consolidation like Coco. Wow, good job. Yeah, definitely consolidation is not a big job. Hakim said, not received. Yeah, I think I saw the message popping up. So parent has sent goods which were not received by the subsidiary after the reporting date. So no, it's still correct. We could make that statement because which were received by the subsidiary after the reporting date. Okay, so the goods were received by them though, but it was after the reporting date. So the statement is still correct. If I want to bring the not, then I'll say which were not received as at the reporting date. Then it will be there in that case. Salim said, watching from Tanzania. Thank you, Salim, for joining us on the stream. Any questions, please? That is the first thing we need to understand about intra-group trading. And this is one of the issues that students always have problem with, and finding out how do you deal with this actually. Now, let me bring up investment in associates quickly, and then I'll share with you some few things there when there is intra-group trading, investment in associates, and then probably go through some illustration with you on that. Do I have that here? Okay, so this is the pro forma that we mentioned about the equity accounting, and I've already explained everything that we have in the pro forma here for the entity, and the rules are just going to be coming up here. So what I want to bring to your understanding is this part of the discussion. So adjustments required on the statement of financial position. If A is the seller, that is the associate is the seller, we reduce the associate retained earnings and the parent's inventory. Then, if the parent is the seller, reduce the parent's retained earnings and the investment in associates as a line item. So the issue here is the issue that we are looking out for here is we are looking at the intra-group trading between the parent and the associate. Like we illustrated earlier in our pro forma presentation, let me bring it up here again. Investment in associate, it was here. I told you that when it comes to the provision for unrealized profit, we only take the parent's ownership of the investment of the associate when dealing with any issue about provision for unrealized profit. We don't take the total figure like we would take when we are dealing with subsidiary. We take only the parents' portion of their investment. We take only the parents' portion of their investment. For adjustments that occur in the P&L account, if the associate is the seller, we reduce the line that is the share of the associate's profit after tax. Then, if the parent is the seller, we will just increase the parent's cost of sales, because if the parent is the seller, then the provision for unrealized profit would have to be added to the cost of sales for the income statement of the entity. So basically, that is the idea about intra-group trading if they sell goods. If they sell goods. If they sell goods. Now, they could also sell assets among themselves. So disposal of assets. Non-current assets, maybe let's be specific on that. Non-current assets. Now, usually if they sell assets, we have to calculate provision for unrealized profit or loss on the disposal and eliminate the results. So this is what is happening. Let me just illustrate the idea to you, then we go. So let's say during the year, the subsidiary, during the year, the subsidiary sold a property, plant, and equipment to the parent. Please stay with me carefully. At the time of the disposal, the subsidiary was carrying the asset at $1,800. And then they sold the asset to the parents at its fair value of, let's say, $2,500. So right now, in the books of the parents, they are carrying the asset at $2,500, and the asset has been derecognized by the subsidiary. But remember, subsidiary will recognize profit on disposal. So included in the subsidiary's profit is profit on disposal, which in this case will be 2,500 minus 1,800, and that's going to be an amount of 700. But remember what we said, the two shall be one. You cannot sell an asset to the parent, or parent sell an asset to the subsidiary and makes a profit on that. So the profit on the disposal of the assets must be eliminated from the accounts of the person who sold the assets. So what is the double entry on that? Very simple. We're going to debit profit for the year of the subsidiary if the subsidiary is the one selling, or we debit group retained earnings. Remember we said when you are debiting profit for the year of the subsidiary, means you are deducting it because they've not made that profit yet. The asset is still in our books. We are still using it. The two shall be one. On consolidation, the two shall be one. The two shall be one. The two shall be one. So we debit the profit of the one selling it for the provision for unrealized profit. Now, if they made a loss, the reverse is true. Okay, if they made a loss, the reverse is true. You know that already. Then we credit property, plant, and equipment with that 700. Now, if it was a loss, like I just mentioned to you, then we would rather debit. If it was a loss on the disposal they had, they would debit PPE with that loss and credit profit for the year or group retained earnings if the parent is the one selling. So just the reverse of the treatment. Okay, just the reverse of the treatment. But remember, it means that on consolidation purposes or for consolidation purposes, the parent entity will charge depreciation on the 2,500. But the two shall be one. So you cannot carry the asset at 2,500. You must carry it at 1,008. That is why we are crediting back the PPE with the 700 so that we will bring back the assets to its original value of 1,800. But you see, the parent entity will charge depreciation. And when they are charging depreciation, they will charge depreciation on the 2,500, which means they will charge more depreciation than they are supposed to have charged if we were looking at consolidation. So the excess depreciation would have to be reversed. How do we reverse that? Since they made a profit, the excess depreciation would debit property, plant, and equipment with the excess depreciation and credit back because they've charged more depreciation than they are supposed to charge. So we have to add it back to the profit for the year if the subsidiary is the one selling, or we add it back to group retained earnings if the parent is the one selling. Are you getting me? That's all. That's all about disposal of assets, non-current assets. That's all. That's all. So if they made a profit on the disposal, reverse the profit. So we calculate the provision for realized profit, reverse it. Then any excess depreciation that was charged due to the acquisition of the assets would have to also be reversed in the books. And that is how we deal with disposal of non-current assets. That's the second item for the intra-group trading. That's the second item for the intra-group trading. That's the second item for the intra-group trading. Any questions, please? You put it in the chat for me, and we can get excited about it. That is the idea about that. That's the idea about that. Finally, is if you are dealing with goodwill, you are dealing with consolidation, there is always going to be what we call fair value adjustment. Always, always fair value adjustment. Now, whether you are doing consolidated P&L or consolidated statement of financial position, you will be required to calculate goodwill. And when you are calculating goodwill, you would have to deal with fair value adjustment. Please note, with fair value adjustment, it is always based on the context of the question. But there are some key standards that play a key role in fair value adjustments. IAS 16 will be there, property, plant, and equipment. Number two, IAS 23 may be there, borrowing costs. Number three, IAS 12 may be there, income tax. Depending on the notes we have available, IAS 37 may be there, provisions, contingent liabilities, contingent assets. IAS 38 may be there, intangible assets. What I'm saying here is that when the company is acquired, their assets must be revalued at the date of acquisition. So when we are revaluing their assets at the date of acquisition, these standards are going to be applicable. IAS 16 IAS 23, IAS 12, IAS 37, IAS 38. So even if you don't like these standards, for you to excel in consolidation, to be able to calculate your goodwill well, and to be able to calculate your post-acquisition profit or loss very well, you must familiarize yourself with these standards. You have to know these standards, because in the fair value adjustment, the description that the examiner will give to you will fall into these categories. Then for those of you doing corporate reporting, the examiner could go extra and bring in issues about pension. So IFRS, uh, you know, 2, share-based payment. And then pension itself, IAS 19, employee benefits. So sometimes in the fair value adjustment, issues about these guys will be there for corporate reporting students. But by default, IAS 16, 23, 12, IAS 37, and then 38. So remember the accounting treatment of these standards. On consolidation, the treatment is the same. On consolidation, the treatment is the same. How you know we deal with deferred tax is the same on consolidation. How you know we deal with intangible assets as per IAS 38 is the same thing here. But you have to understand these standards well, because in the fair value adjustment treatment, this is what is going to be there. Then finally, sometimes the examiner will not give you the retained earnings at the date of acquisition. So if the examiner doesn't give you the retained earnings at acquisition, how do you calculate it? Very simple. All you do is bring the retained earnings, certainly of the subsidiary, right? So the retained earnings at the reporting date. And that's not a miracle. It will be given to you on the face of the statement of financial position. So you pick it up. Then you less or add profit or loss for the year. You will less if they made a profit, but you will add back if they made a loss. Why? Because if you remember the statement of changes in equity, to get a closing retained earnings, we add the profit for the year. So if they made a profit, we will come and subtract it. If they made a loss, we will add it back. Why is that? Because that will give us the retained earnings at the beginning of the year. That will give us retained earnings at year start. Now, if the acquisition was done at the beginning of the year, then this is your retained earnings as acquisition. Simple. If the acquisition was done at the beginning of the year, then this is your retained earnings at acquisition. But if the acquisition was done midway through the year, then what is going to be happening is that we will have to add pre-acquisition profit. Okay, we'll have to add pre-acquisition profit, so that that would then give us the retained earnings at acquisition. That will give us the retained earnings at acquisition. So if retained earnings at acquisition is not given, this is how you calculate it. And it could either be the retained earning at the dates at the year start, which is if we did a revaluation at the beginning, if we did the acquisition at the beginning of the year, or retained earnings at the reporting date if the revaluation is made partway through the year. That is how we calculate the retained earnings at the date of acquisition, where in the question it's not given. Any questions? These are some of the key principles that we need to understand when it comes to dealing with consolidated financial statement. When it comes to dealing with consolidated financial statement. These are the things that we need to understand. Any questions for me? Any questions for me? Any questions? Once you understand these key principles, you will be able to get majority of the marks in the consolidation. Please do not hurry up and go and extract consolidated profit or loss, consolidated statement of financial position. Please, you won't get marks for that. Do your workings and go and prepare the financial statement. Do your workings and then go and prepare the financial statements. That is how you structure out. If you do your workings and you're not able to even finish, you get majority of the marks rather than if you go and extract financial statement and don't get anything that has to be posted there. So that is basically what you have to understand about some of the core principles and the issues in consolidation you have to note of. So that's it. Establish your group structure, know your NCI, know how to calculate the fair value of consideration transferred, your net asset schedule, the fair value adjustment issue, you have to know about that very well. Then the retained earnings at acquisition, if it is not given, you have to calculate it. Then you calculate your goodwill. If the goodwill is positive, less impairment, it will go to the statement of financial position. If the goodwill is negative, that is a gain on acquisition. And so that gain on acquisition would have to be recognizing the group retained earnings of the entity. And that is how you deal with these things. Remember, where there is impairment in goodwill also, its treatment depends on whether NCI is valued at fair value or valued at a proportionate method. Where NCI is valued at fair value, then the impairment in goodwill will be shared between the parent and the NCI using their share of ownership in the subsidiary. But if NCI is valued at a proportionate method, then the impairment in goodwill would solely be the responsibility of the parent entity. And then intra-group trading, dealing with the total sales, dealing with the provision for unrealized profits, and dealing with the reconciliation of the current accounts between the parent entity and the subsidiary. These are the things that you must understand when it comes to consolidation. But most importantly, also the theories, how control is obtained, accounting for negative goodwill, why goodwill will be negative, how to obtain significant influence or indicators of significant influence, accounting for you know investment in associates, then issues relating to some of the things we explain about who can prepare consolidated financial statements, who cannot prepare consolidated financial statements. So it's very important you understand these theories as well as you try to finish up with the calculations. And if you do this, you should be able to get majority of the marks relating to consolidation and put yourself in the spot so that you can pass the examination. So that is what you need to understand about consolidated financial statements, and that is what we want to share with you in this masterclass on consolidation. What else we got? I'm seeing some charts coming in here. Let's see. What do I have? Abugri Zacchaeus said, well done, sir. Thank you, Zacchaeus, for joining us on the stream today. So that's it about that. And we're going to conclude around here today. We have a management accounting lecture. So I have to jump off the call today, right now. So, God willing, Friday, we are going to be finishing up and talk about some issues. Saturday, I'm going to be coming your way with some Q&A sessions, and maybe Sunday evening too, I will come your way with some Q&A sessions. So Friday we will be meeting, Saturday we will be meeting, Sunday we will be meeting, and during the course of the week, we will be meeting for the subsequent papers exam as well for a Q&A session so that we can focus on the specific issues for the specific subjects that you are writing. And we'll do these to, answer questions that you have and also provide you with assistance that you need so you can really position yourself to pass the exams. So that's it about that. Stay safe, continue to study, and I'll see you same time on Friday at 4:30 p.m. as we continue with our discussion. Bye-bye.